be called to order. First item of business would be requests for bill introductions. Do we have any new requests today? Seeing none, we'll move right on to our first hearing of the day, and that is House Bill 2231. And I'll turn to the reviser for a brief overview on that, please.
Thank you, Mr. Chairman. House Bill 2231 would provide a head of household tax filers an additional Kansas exemption in the amount of $2,320, and this will apply for tax year 2024 and then tax years thereafter.
Thank you. Pretty straightforward there. Committee, are there any questions for the reviser? See none. Thank you, Adam. I think we'll go ahead and pass over the fiscal note. We will address the fiscal impact in testimony probably because this is the way things are being interpreted. It's my understanding right now at the department. This just gives some statutory clarity to how we're interpreting that law. So we will open it up to the proponents and welcome to committee Zach Denny. Or Mr. Secretary, I wasn't sure who was testifying.
I would gladly defer to Mr. Denny.
Yeah, I saw a little deer in the headlights look from Mr. Denny back then. No, I'm kidding.
Thank you, Mr. Chairman, members of the committee. This is a relatively straightforward bill, and it does address a matter of clarification within our statute. And essentially, what has happened, and my written testimony will lay out a little bit of the statutory history here. But in 1997, the legislature authorized an additional exemption for head of household, okay? And it remained on the books for 21 years to 1998. And over that period of time, the exemption amount increased over the years. In 1998, though, when they did the increase, some of the language was omitted in the bill that would suggest that the exemption didn't last beyond 1998 for head of household. Notwithstanding that language, an additional exemption has been allowed for head of household for the next 25 years, including 2025. It was done that way because it was a perceived legislative intent that there was never a desire to do away with that particular additional personal exemption for head of household. All this legislation does is clarify that that is in fact what the legislature's intent was, and really just sort of reaffirms what has happened over the last 46 years in terms of granting this particular additional exemption to head of household. The fiscal note is, well, there is no fiscal note. This has all been taken into account in every fiscal note, every consensus revenue estimate since 1998. So, in including the current estimate. So, there is no additional fiscal note with this bill. So, I'd be happy to respond to any questions that you might have.
Okay. Thank you, Mr. Secretary. Committee, are there any questions? Yes, Representative Carlin.
Thank you, Mr. Chair. Hi, thank you for being here. I had not read this bill. I just looked through it quickly. Can you tell me who is the head of household, please?
Well, that is determined at the federal level, and essentially you're looking at minor children. You can have, an individual, A single parent who has minor children would be a head of household. You could have a situation where you might have family members that you are providing care for that would cause you to fall into the head of household category. But again, the personal exemption at the state level is just piggybacking onto what is allowed at the federal level. And that's where the determination is made.
So is there an allowance for us to bifurcate from the federal level? Or do we have to stick with that?
I believe the legislature has the discretion to set Kansas tax policy as it sees fit. It's not necessarily totally tied into the federal code, but
Thank you. And I think what I needed to know was, I mean, I'm a widow, I'm a head of household as far as I'm concerned. I have all the responsibility for everything, including grandchildren and great-grandchildren and ex-wives and husbands and all. And so I have a lot of responsibility, but I'm not qualified as head of household. And this doesn't change that.
no.
And I just wanted to be sure I had not been in error in my filings. Thank you. Thank you.
This doesn't do anything to change who qualifies as a head of household, which is dictated at the federal level.
Okay, thank you. Thank you, Mr. Chair.
Thank you. Committee, are there any further questions? See none. Thank you, Mr. Secretary.
Mr. Chairman, I might point out one other item when you look at this bill, and it has nothing to do with the additional head of household, except as it relates to the disabled veterans. If you look at the dollar amount on line 30, it's $22.50 for disabled veterans, which is different than the $23.20 for everyone else. Just calling that to your attention, not knowing if there was a specific legislative desire to make that differentiation.
No, thank you for pointing that out. I think the number was $22.50 before Senate Bill 1, which made that adjustment. So if we're going to maintain some continuity, I might foresee an amendment coming. So
Thank you.
See no further questions. Thank you for your testimony. Is there anyone else wishing to appear as a proponent on 2231? Any opponent or neutral testimony? Seeing none, we'll close the hearing on House Bill 2231. We will now turn our attention to a hearing on Senate Bill 10, and I would ask the reviser for a summary on that, please.
Thank you, Mr. Chairman. Senate Bill 10 would provide a property tax exemptions for certain property, including watercraft, marine equipment, off-road vehicles, motorized bicycles, certain trailers, and aircraft. For 2026, beginning with tax year 2026, the exemption would apply specifically to any off-road vehicle that is not operated upon any highway, any motorized bicycle, electric-assisted bicycle, electric-assisted scooter, electric personal assistive mobility device, and motorized wheelchair, any trailer having a gross weight of 15,000 pounds or less and is used exclusively for personal use and not for the production of income, any marine equipment, and any aircraft. The bill would also, in a separate provision, exempt all watercraft from property and ad valorem tax commencing January 1 of 2026. And then lastly, the bill would exclude these exemptions from having to go to the State Board of Tax Appeals for an application process to be approved of the exemption. And with that, I'd be happy to stand for any questions.
Thank you, Adam. Could you give us a brief explanation? I know we've had this in years past as a constitutional amendment. What allows this to be done in statute versus a constitutional amendment, since these the personal property is in the Constitution?
The Constitution does allow for exemptions of tax. You generally can't pick and choose certain certain groups or relating to ownership or use, but if you generally exempt the field or that's what makes it constitutional.
So this does include like an entire subclass or field?
I'm not sure it does that, but essentially these subset of vehicles that are essentially all exempted if they meet these definitions.
Okay. Committee, are there any questions for the reviser? Representative Turner, and then Representative Smith.
Thank you, Mr. Chair. And maybe you said this in your comments and I missed it, but what's the connective tissue amongst all these devices that are listed here? All the way from boats and airplanes and helicopters and trailers. Just, did somebody just carve these, or is there some connective tissue here? Thank you.
Mr. Chair, to be honest, I know aircraft wasn't included and they included it. These are all personal property subject to ad valorem tax. If there are other things outstanding, I can't name off the top of my head. I'm sure there are. These were items selected to be included in the bill.
So it's just the way the bill was filed and amended. All right, thank you.
Representative Smith?
Thanks, Mr. Chair. Thank you. On watercraft, does that mean all watercraft? I mean, some's very small, some's very large.
That is correct. All watercraft that would be subject to ad valorem tax would be exempt from property tax.
Thank you. Thank you, Mr. Chair.
So that would be like boats, jet skis, I mean, any type of, I guess I'm not sure, I hadn't looked to see what the definition of watercraft was. Okay.
That's correct.
Okay. Representative Sanders.
Thank you, Mr. Chairman. But isn't there a weight limit?
I believe that applies to the trailer aspect. Certain trailers are excluded, but that's not, the weight.
Doesn't apply to the watercraft?
No.
Okay, thank you. Thank you, Mr. Chairman.
Seeing no further questions, thank you, Mr. Siebers. We'll now turn to Department of Revenue for an overview on the fiscal note.
Mr. Chairman and members of the committee, Kathleen Smith with the Department of Revenue. Senate Bill 10, we're estimating that Senate Bill 10 would decrease revenues to the Educational Building Fund in the amount of $137,000 and to the State Institutions Building Fund in the amount of $68,000, almost $69,000. Less property tax revenue would also affect state expenditures for aid to school districts to the extent that less property tax revenue would be available from the state's uniform mill levy to fund expenditures for school districts. The state would be required to provide an additional amount of $2.7 million in state aid from the state general fund through the school finance formula.
Kathleen, if I'm going to do some quick math here, and I might turn to research to double check this. If the 1.5 mils, the 137,000 and the 68,000, that represents 1.5 mils. And I might ask research if we can extrapolate that to an average mill levy statewide. I think it's about 130. Is that about the average? 127. So that would be roughly $17.3 million impact to local governments.
I haven't done the math.
Okay. Well, what I'm doing there is I'm adding, obviously, 137 plus 68 is 205,000 divided by 1.5 to get a per mill value, and then multiplying that by 127. I know and we'll hear from the County Appraisers Association, I know they say that this is minimal impact, but I do want to focus on the fact that that's $17.3 million that will be kind of shifted onto other taxpayers at the local government level. Even though it looks like the impact of the state is pretty small, we only have 1.5 mils. When you look at the full levy that some cities and counties have, it is a little bit of an impact.
Yes.
Okay.
Yes, sir.
Committee, are there any questions for Department of Revenue? Representative Francis?
Thank you, Mr. Chairman. And your fiscal note, does it include the impact of the aircraft that were added in the Senate?
Yes, it does.
It
Yes.
does.
Representative Awerkamp?
Thank you, Mr. Chairman. If you can run some quick math, what percentage, I think you said 17 million to the locals, what percentage of the property tax to the locals is that 17 million?
So, not sure I understand your question.
Sorry, Mr. Chairman. So how much do the locals bring in through their property taxes? So if they don't get that 17 million, what percentage of their total hit is that?
I might turn to Eddie on that one. If you're looking at that total, what is it, $6 billion of property tax?
Yeah, I think it shakes down to about 0.2%.
Committee, any further questions for Kathleen? Seeing none, thank you again. We'll open up the proponent section testimony and welcome first the Honorable Senator Stephen Owens. Welcome back to the House.
That honorable bit, but it is certainly glad to be back amongst colleagues from the House. And I appreciate the opportunity to stand in support of this. So specifically, I wanted to talk about SB 10 and the amendment that was added on aircraft. I realize the appraisers were in support of that, and having spoke with them, they're in support of this amendment. But I know that there's been some question of, well, why did we add aircraft? Well, there's a lot. It's important to understand with aircraft, obviously, Kansas and especially South Central Kansas and Wichita is the aviation capital of the world. And what we've seen is too many of our airplanes are going elsewhere to be housed. Even though in Kansas, and this is all in my written testimony, in Kansas, we already exempt all commercial aircraft and business use aircraft. So those are all already exempted. In addition, in Kansas, we already exempt all aircraft that are 30 years old or older. You just have to jump through a whole lot of hoops to make that happen and go through the BOTA process and things like that. I happen to own an aircraft that's older than 30 years, and as a result, I went through that process. And while I was successful, I had a constituent reach out to me from Sedgwick County who I was just able to assist in fixing that problem because he checked the wrong box on the BOTA form because you've got to fill out a bunch of paperwork, take it to your local county, and then you pay the fee and send it to BOTA. This would eliminate all of that and just say, no, it is expected to be exempt, and it is exempt. We also already exempt all amateur-built aircraft and home-built aircraft as well. So we're really talking about a very small subset of aircraft, but I firmly believe that by doing so, we'll not only bring many of the aircraft back in the states, similar to how we will with boats. As we know, boats are something that is commonplace to be registered in other states, entitled in other states too, because other states don't have this tax. And so I just wanted to stand here and take any questions as to kind of why my logic existed in adding aircraft to this. And so I'll stand for questions, Mr. Chairman.
Thank you, Senator. Committee, questions? Representative Turner.
Thank you. Same question I asked earlier. Why this list of, looks like a mishmash list of watercraft, airplanes, golf carts?
Well, I'm pretty sure if we could all afford to add automobiles to it, we'd add that as well. But the reality is I think we're whittling down in the state of Kansas the amount of items that are subject to personal property tax, right? And if you look at over time, we've continued to pare back those items that are subject. In many ways, it's one-off and two-off situation, like aircraft that are over 30 years older. A different year, it was aircraft use and business use, right, to support our aviation industry. So I think this takes kind of a more blanket approach because really, when you add all of these items on here, I'm willing to bet that the list of items that are now subject to personal property tax are limited to vehicles and maybe RVs and just a very limited number. So I think overall it is just an effort to pare back the amount of personal property tax individuals are paying and then also bring some of those vehicles back home from out of state where they're currently housing or titling them to avoid taxes.
Thank you. Yeah, I was wondering, how the taxing entities even know about some of these things, like a motorized bicycle. I didn't even know those were taxable until I read this. Because there's no need to license it, but apparently maybe there's a reason to register it. But anyway.
So for example, I can tell you, and I know the county appraisers who's going to testify after me in support of this will also share with you that in many instances, it costs the county more money to find these items and to tax these items than they're actually receiving in revenue. And they certainly have different ways. For example, in Heston, Kansas, where I live, for $20, I can go get a little sticker on my off-road vehicle so I can drive it in town, like my golf cart or UTV. Well, unbeknownst to me, they turn around and provide that list to the county so the county can make sure those are on the property tax rolls, right? So there's all these different ways that they're going about this, because like an airplane's not titled, it's registered. And then they have to search a database to see whether it's actually housed in that county to know whether they can tax it. So it's a convoluted process on a lot of levels.
Representative Corbett.
Thank you, Chairman. And I agree with you. I had a constituent that had like a 12-foot flat bottom John boat. And he told me what he had to pay on personal property tax. But back then, if you missed that date, they doubled your tax. You remember, on your personal property? Ouch. And I'm glad to see this stuff go. I mean, it's hard to believe we could let something out of the state we couldn't tax twice, but just blink your eyes, maybe we can get it.
Any further questions, committee? Seeing none, thank you for your testimony.
Absolutely. Thank you, Mr. Chairman and committee.
Next, we'd like to welcome Representative Fairchild. Is he here? That may be written only testimony. Next, I would welcome Sean Robertson. Welcome to committee.
Thank you, Chairman, members of the committee. Sean Robertson, I'm Saline County Appraiser, representing the Kansas County Appraisers Association today. We come in support of this measure. We've brought it before. Did want to split this up into 3 different sections that hopefully I'll be able to answer some of the questions that have been asked already. First of all, I want to talk about these smaller items, ATVs, UTVs, trailers, golf carts, that kind of thing. I want to give you an example. These smaller type trailers that you can see in any parking lot of a farm supply store or a home improvement store. 3 people go to purchase those trailers. One of them is hauling a hay bale for his farm. It's exempt because it's farm use. Another has a lawn mowing business, hauls their lawnmowers on it. It's exempt because it's commercial personal property. The third person hauls an old couch to the dump. They pay taxes. The part about the small items that we're talking about is simply a fairness issue. The only people who are, in general, I won't say every single person, but in general, the only people who are paying the taxes on these smaller items that are mentioned here are the residential people. So in this case, yes, it would be a shift in taxes to all classes, but away from residential. Okay? The watercraft, this began with a 2012 constitutional amendment that was voted on in November of 2012. The reduction from a 30% assessment rate was not done in 2013 because of that election date and then the next tax year being so close to that. There's a lesson to be learned there on other things. But 2014, it was reduced from 30 to 11.5. 2015 down to 5%. So let me give you an example. You know, a pretty nice, solid $5,000 bass boat, 5%, $250 assessed in most jurisdictions around the state. That's somewhere between $20 and $35 in tax. It is simply not worth the county's effort and time to go through and find all of these boats and tax them. We do not get enough in tax to make it worthwhile. As I said, back in 2012, we, as a population, had agreed to reduce that assessment rate by 25%. Exempting these will only reduce it another 5%. The aircraft were not part of this original bill. This, as Senator Owens had stated, was brought in committee. I do want to talk about, though, Senator Owens did briefly, there are 3 ways which aircraft are already exempt. I'll give you an example. In Saline County, there are 10 aircraft which are currently on the tax rolls. However, they total about $7.5 million appraised. However, 8 of those currently have a pending exemption at the Board of Tax Appeals that we're waiting on the order to go ahead and exempt those. I will note that 4 of those have been waiting since 2023. There are the other 2, by the age, appear to be able to be exempt. We have sent paperwork to the owners, and they just haven't filed it. So although in Saline County in general, I mean, specifically, there are 10 on the tax rolls, it appears that it very well could be 0 even without these being exempt. So I would defer the choice of adding these to those within the bigger counties that have multiple airports and many aircraft. But I guess my point is there may not be as many that will be exempted as it might appear to you. One thing that I really think is important in this is I think that especially the watercraft and the smaller items we're talking about, I think it's somewhere between possible and probable that this will be a boost in sales of these items, to which the locals and the state will collect sales tax. I think that would be a benefit that might not be seen in this bill. So also I would note that having no Board of Tax Appeals application for these things to be exempt is a huge part of this that we support. And despite what I've read on the internet the last couple weeks, I don't own any of these items, so this isn't for me. Anyway, with that being said, I would stand for questions.
Thank you, Mr. Robertson. Committee, are there questions? Let's see. Representative Avercamp.
Thank you, Mr. Chairman. So I'm going to make an assumption the side-by-sides for kind of recreational purposes, they're included in this exemption. I believe, is that correct?
I might turn to the reviser for an interpretation on what
The side-by-side.
recreational vehicles might be.
Rangers and Can-Ams and situations like that, yeah.
Thank you, Mr. Chairman. Those should fit under definition of recreational off-highway vehicle, but I'd need to confirm that, but I believe they are.
Okay, thank you. So I'll try to make it quick, but for the retail stores that sell ATVs and all of these things, can you walk through the process of an owner of one of these vehicles, if he wants to trade it in and bring in the title, if he hasn't registered it before, there seems to be a complication on the trade-in to where he would have to pay back registration in order to get it up to date. Is that correct? And can you dive into that?
That I don't know. The registration is a separate part from the property taxation part, and I'm just not familiar with that part of it.
I'm sorry, I intended to say the property taxes. Do they have to be up to date on property taxes in order to trade it in for a new vehicle?
I'm not familiar with that either. That I don't know.
Thank you, Mr. Chairman.
Committee, further questions? Representative Sanders.
Thank you, Mr. Chairman. Thanks for being here, Sean. Is part of the issue locating these vehicles?
Yeah, that's exactly it. You know, currently, although We certainly don't like to do that. Locating, discovering these things, and putting them on the tax roll is part of our job. And this would remove that part, which takes a lot of time, takes a lot of effort, takes a lot of county resources that could be allocated to doing our job of valuing real estate much better, and or cutting the budget at the local level, which is a benefit to everyone.
And then I think I understood you to say in some cases, even if you can get them located, the effort and cost to do that is not even met by the taxes that they generate.
That's exactly right.
Okay, thank you. Thank you, Mr. Chairman.
Any further questions? I have the question, it might be maybe PVD, Department of Revenue, a question instead, but do you have a list? Is it possible to get a list by county on what the impact would be? How many of these properties, this personal property is within each county? Does the CAMA system allow that to?
Yeah, that shouldn't be a problem.
Okay, I might reach out to PVD and just for the committee's information, see if we can get that county by county data. Okay. Seeing no further questions, thank you for your testimony.
Thank you.
Okay. That's all I show for proponents. Is there anyone else wishing to appear as a proponent under Senate Bill 10? Seeing none, we do have opponent testimony. I'd like to welcome to committee Jay Hall.
Good afternoon, Mr. Chair, members of the committee. I am Jay Hall, the Deputy Director and General Counsel for the Kansas Association of Counties. I want to make it clear that I'm not here to talk about the original bill. I'm only here addressing the amendment that came on in the Senate. I actually didn't even testify on this bill in the Senate because we have no issue with the original bill because it does, in fact, in many counties cost more to locate those properties than it does to bring in the taxes themselves. And so I didn't testify at all on Senate Bill 10 in the Senate. The addition of the aircraft portion, though, does raise the question of whether this bill is still doing what it was intended to do when it was introduced, and that is the purpose of my opposition testimony today. Again, I don't have a problem with the original bill, but it's just adding that portion that seems to be different than the underlying bill, which would have simply eliminated items that locating them is more expensive than the tax they actually bring in. That was the main concern, and that's why I stand here before you today. Otherwise, you would not be hearing my voice. So with that being said, I'd be happy to stand for questions.
Thank you. Committee questions? Representative Corbett.
Thank you. Do you have any idea, with your mention of airplanes, how much money you're talking, or are you just opposed to the airplanes altogether?
So I don't have an exact number on the amount that it would cost. My concern is that the airplanes themselves are different in that they bring in more tax than it costs to track them versus the personal property, which is more expensive to track and tax than it is the actual tax that they bring in.
So you're just upset that they're not taxing them. Is that the problem? You're unhappy that they are going to not tax the planes at all now. That's what bothers you the most?
It's different. My distinction is that the airplanes are different than the small watercraft and the ATVs and things like that, in that tracking them for the personal property tax, those smaller vehicles, the small recreational vehicles, is more expensive than the actual tax that is generated. And aircraft seem to be a different category of property than that. That's the difference that's the distinction that I'm drawing. That's what we discussed with the appraisers and some of the others when we discussed this in the summer, that they were going to support the original bill.
But the last guy that just testified kind of disagreed with what you're saying on that there are already many exemptions for certain planes of age and whatever, and that whatever's left doesn't It's just pencil dust. Apparently you don't agree to that.
I would disagree that it's just the pencil dust, but I do know that that many aircraft are already exempt, and we're not trying to disrupt that situation.
Thanks.
Further questions, committee? Seeing none, thank you for your testimony.
Thank you.
I do not show any other opponent testimony appearing before committee. Is there anyone wishing to appear as an opponent? Seeing none, I would draw the committee's attention to written-only testimony. Is there any neutral testimony? Seeing none, we will close the hearing on Senate Bill 10. We will now turn our attention to hearing on House Bill 2208, and I'd turn to the revisor's office for an overview, please.
Thank you, Mr. Chairman. House Bill 2208 would enact the Endow Kansas Tax Credit Act, which provides for an income tax credit for endowment gifts to certain endowment funds held by qualified community foundations. The bill would provide an income and privilege tax credit starting in tax year 2026 in an amount equal to 70% of the amount of an endowment gift by a taxpayer during the taxable year to an unrestricted permanent endowment fund or field of interest permanent endowment fund held by a qualified community foundation. A minimum endowment gift of $500 by the taxpayer shall be required for a taxpayer to receive the credit. Under the bill, the total aggregate amount of tax credits allowed for each taxable year shall not exceed $3 million for tax year 2026, $4 million for 2027, $5 million for 2028 and thereafter. In no event shall the total amount of credits for endowment gifts to a single qualified community foundation, excluding affiliates, or to a single affiliate of a qualified community foundation exceed 10% of the total aggregate amount of credits per tax year. The total or the amount of such credit awarded to a taxpayer for a taxable year shall not exceed $100,000 for an individual or fiduciary taxpayer subject to income tax, $200,000 for married taxpayers filing a joint return, or $200,000 for any taxpayer subject to corporate income tax or the privilege tax on financial institutions. The tax credit would be a non-refundable tax credit. However, there would be a 5-year carry forward. The tax credit would not be transferable. In order to participate under the bill, a qualified foundation would have to be required to apply to the Department of Revenue for a certification that the entity is a qualified community foundation and satisfies all the criteria to be considered a qualified community foundation. And then prior to claiming any credit, a taxpayer would be required to apply for a credit with the Department of Revenue on forms furnished by the department. The taxpayer would be required to certify the dollar amount of the endowment gift made or to be made during the taxable year, the name of the certified qualified community foundation, and any other information required by the Department of Revenue. Within 30 days after receipt of an application, the department shall allocate credits. The taxpayer would then be required to make payment or within 30 days to receive the credit, 30 days or the end of the tax year, or the allocation would be canceled, and such credits would then essentially be returned to the Department of Revenue. And with that, I'd be happy to stand for any questions.
Thank you, Mr. Siebers. Committee questions? Seeing none, thank you again. We will now turn to the proponent section testimony and welcome first to committee, Christy Tustin. Welcome to committee.
Thank you. Good afternoon, Mr. Chairman, members of the committee. Thank you for the opportunity to speak today. My name is Christy Tustin. I'm the Executive Director for the Kansas Association of Community Foundations. KACF is a leadership organization representing 116 community foundations and affiliate community foundations across Kansas. Joining me today are representatives from 5 of our community foundations across the state, including Greater Manhattan, Legacy Regional in Winfield, the Topeka Community Foundation, Douglas County, and Greater Salina. I'd also like to draw your attention to the comments from 20 or so other community foundations across the state that include some really good examples of how this could impact their work in their specific areas. But I'm here today to express our strong support for House Bill 2208, which would create the Endow Kansas Tax Credit Act. Community foundations are tax-exempt charitable nonprofit organizations established to serve a specific geographic region. Community foundations build funds that support community needs with a focus on creating endowment funds for the long-term benefit of local community projects and programs. They're a vehicle for people of all means to make a lasting difference in their community. Community foundations serve as key institutions in many communities to promote charitable activity, but are particularly important in rural communities that may not have any other anchor institutions. Kansas community foundations vary widely in total assets and capacity for community investment and are largely focused on supporting key community priorities such as health, childcare, education, housing, and economic opportunity, just to name a few. Kansas community foundations cover nearly every county in Kansas. They strengthen their communities by working with donors and building endowment funds. They provide grants to local organizations and scholarships to their local students. And they promote philanthropy through community leadership. Most importantly, community foundations are perhaps one of the few organizations focused on building broad, unrestricted endowed funds designed to address both current and unforeseen community needs. Community foundations are uniquely committed to this essential work. The Endow Kansas Tax Credit Act would create an income tax credit for taxpayers who provide an endowment gift to an unrestricted or a field of interest permanent endowment fund held by a qualified community foundation in Kansas. A field of interest fund is just simply designated for that particular area, such as the arts, healthcare, childcare. It could also be for a particular county or community. A tax credit program for endowment gifts empowers communities by encouraging charitable contributions that create lasting local impact. By incentivizing philanthropy, the program maximizes and leverages private funds, turning individual donations into sustainable resources that support nonprofits, community projects, and future needs. With Kansas facing a historic transfer of wealth, this initiative ensures that more of these assets remain in local communities, benefiting residents for generations to come. The program also inspires new giving, motivating individuals to invest in the future of their hometowns and strengthening the culture of philanthropy across the state. Beyond financial impact, a tax credit for endowment gifts helps cultivate local leaders who are committed to community growth and long-term success. By positioning Kansas and its community foundations as champions of philanthropy, the state can set an example for how public-private partnerships can drive meaningful and lasting change. I'd like to point out how this proposed program differs from some existing tax credit programs. This proposed tax credit program operates on a first-come, first-served basis, ensuring that all donors have an equal opportunity to participate until the statewide aggregate cap is met. Unlike some existing tax credit programs that allocate a set amount of credits to specific organizations or projects, this initiative is designed to be broadly accessible, allowing donors to support any qualified community foundation endowment. This flexible structure encourages widespread participation and maximizes the impact of charitable giving across Kansas. By adopting this approach, the program fosters a more expansive and dynamic model of philanthropy, ensuring that resources are directed where they can have a significant and lasting impact. Providing a tax credit incentive to promote giving to permanent endowments works. Our proposed tax credit program is modeled after successful initiatives in other states that have significantly strengthened local philanthropy and community foundations' impact. States such as Iowa, Illinois, Kentucky, Maryland, Mississippi, Montana, and North Dakota have implemented tax credits for gifts to endowments, resulting in increased charitable giving, stronger nonprofit sectors, and greater long-term community investment. For example, Montana's endowment tax credit has been in place for over 2 decades, generating over $145 million. Similarly, Iowa's Endow Iowa tax credit has led to more than $350 million in endowment gifts, benefiting communities of all sizes. North Dakota's tax credit for endowment gifts has successfully encouraged donors to invest in their local community foundations, ensuring long-term sustainability for their nonprofits and community initiatives. And in its first 2 years, Endow Mississippi leveraged $4 million in donations to endowment funds at Mississippi Community Foundations. The success of these programs demonstrates that tax incentives work. They encourage more donors to contribute to endowments and keep charitable dollars local. Kansas has the opportunity to replicate and build upon these proven models, ensuring that communities across our state have the resources they need to address both current and future challenges. Our Kansas community foundations have called such a program for endowments a game changer, critical to sustaining impact, invaluable, a necessity, and an inspiration to donors. Additionally, the tax credit incentive can spark initial giving conversations, potentially leading to a donor's first gift and inspiring a more substantial planned gift later on. By implementing a similar tax credit program, we can significantly increase charitable giving, retain wealth in our communities, and create a lasting impact that benefits both rural and urban areas. This is a smart, sustainable approach that not only supports philanthropy, but also reduces long-term dependence on government funding by strengthening local resources and empowering our local communities. Over the coming decades, Kansas is facing a historic transfer of wealth, as billions of dollars will shift from one generation to the next. Without intentional action, much of this wealth could leave the state, directed to out-of-state heirs, national charities, or large institutions with no direct investment in Kansas communities. A tax credit for gifts to endowments provides a powerful incentive to keep more of these assets local, ensuring that communities across Kansas benefit from long-term philanthropic investment. By encouraging individuals to support community foundation endowments, this tax credit helps capture a portion of the transfer of wealth for charitable purposes. Endowed funds provide a permanent source of support for local nonprofits, community projects, and future needs, ensuring that communities of all sizes continue to thrive for generations to come. Without this incentive, the opportunity to retain and grow local charitable resources may be lessened, weakening the ability of communities to respond to future challenges and opportunities. According to Kansas's latest transfer of wealth study, over the next decade, Kansas is poised to see a significant generational wealth transfer totaling over $398 billion. Capturing just 5% of that wealth transfer for community foundation endowments by the year 2035 could result in a substantial estimated over $18 billion boost to local communities and their projects. The study projects an astounding $1.1 trillion transfer in wealth over Kansas over the span of a half a century. Kansas community foundations recognize that incentives such as tax credits encourage charitable giving. Unrestricted gifts, while often the hardest to secure, provide the greatest flexibility and impact in meeting ever-changing community needs. Unrestricted endowments are one of the most effective tools for sustaining long-term community support. Unlike restricted funds, which are designated for specific purposes or charitable organizations, restricted endowments provide the flexibility needed to respond to emerging challenges and opportunities, many of which we cannot predict today. However, securing these types of gifts can be difficult, as donors often need an extra incentive to encourage this type of giving. A state tax credit would create a powerful public-private partnership, encouraging more Kansans to invest in their communities while leveraging private dollars for long-term benefit. Endowment funds provide a stable, ongoing source of support for local nonprofit organizations and initiatives, bridging funding gaps and securing the future for essential programs. And endowments established for a particular city or county give residents the opportunity to invest in their community's evolving needs, adapting to challenges and opportunities over time. I urge you to consider this policy and what impact it could have on both rural and urban areas across Kansas. By incentivizing gifts to unrestricted endowments, the state can help ensure that our communities remain strong, resilient, and well-equipped to meet the challenges of the future. Kansas, through House Bill 2208, has an opportunity to empower residents to significantly increase charitable giving through tax credits, helping to grow local philanthropic resources. By leveraging these incentives, community foundations can maximize their impact, ensuring greater support for nonprofits and addressing critical community needs. I encourage you to advance this bill. And I'd stand for any questions you may have. Thank you.
Thank you. Committee, are there any questions? Representative Sawyer.
Yeah, thank you, Mr. Chairman. I'm curious how you came up with the 70%. That's a very generous tax credit.
It's a number that we feel is attention-getting, and it would really encourage people to give to an unrestricted endowment, which, as I said, is one of the hardest gifts.
I would assume these would also be deductible as itemized deductions on their federal income tax, these contributions.
I'm not sure I can speak to any of the tax questions. I'm not prepared for that today. I'd have to check.
Okay, but somebody in like a 35% or higher tax bracket would get 35% or more back on their federal income tax, and then they get a 70% credit of the total amount on the state. They would be getting their entire contribution back in tax savings. So they really hadn't contributed anything.
I'm sorry, so they what?
The net effect is they really wouldn't have contributed anything because they would have gotten more back in tax savings than they contributed to the endowment.
Right. 70% was our starting point.
Okay, all right, thank you.
Representative Avercamp.
Thank you, Mr. Chairman. So on that point, the 70% and what is deductible at the federal level, may I ask research to clarify that? Because I did ask research over the summer, and if I'm going to just jump the gun and just tell me if this is correct, but I think the IRS changed their rules on that back in 2018, and their new rules established that only the amount contributed to the nonprofit, which was not part of the tax credit. So in this case, only 30% would be deductible on the federal level, but if I may ask research to verify that.
Yeah, that's generally correct. With one clarification, it was 2019, not 2018, when the feds changed that rule. So it's a Treasury Decision 9864, which is finalized proposed regulations that had been initially proposed in 2018, and so if a taxpayer makes a $1,000 contribution and receives a $700 state income tax credit, only $300 of that is deductible at the federal level as an itemized deduction.
Go ahead.
So, yeah, thank you, Mr. Chairman. I think it's just interesting because this is a debate's been brought up at the well a few times over the years and in committee, and so I did ask research to double check that over the summer and take a look at some of the low-income tax credits for school scholarships and that whole program, and that's where that got brought up. Thank you, Mr. Chairman.
Okay. Representative Sawyer.
That tax act is also temporary. It's set to expire, so who knows what happens. It depends on what Congress does. It could go back to the old rules.
Any further questions for the conferee? See none. Thank you for your testimony.
Thank you very much for your time.
Our next conferee would be Vernon Hendricks. Welcome to committee.
Thank you, Mr. Chairman and members. I'm glad to be here. I've enjoyed a nearly 50-year career in the world of development, in athletic development, university development, and now community foundations. And I'm a big believer in the community foundation world because it's more of a reactive fundraising nature, and we're able to work with individuals and what their interests are and needs are, and thus the community needs are high priority here in this whole process. If you look at the way philanthropy works these days, a lot of it's generated because of personal interest or an opportunity to make a difference. Unrestricted endowments are hard because people like to put their money to work right away. Most of us, our endowment spending policies are in the 4% nature. But I would have you reflect on in Manhattan, we had a gentleman named Phil Howe that essentially about 13 years ago put $40,000 up for a match day that would enabled us to raise $100,000 that day at a 50 cents to a dollar on the match. That match day subsequently last year raised over $2 million. We also have 20 partner community foundations with the Manhattan Foundation. 16 of them had match days last year. thanks to the incentive that the Patterson Family Foundation gave them by adding $70,000 to each for their match days here again at a match of 1-to-1 from that standpoint. Those community foundations collectively were able to raise nearly $8 million last year. Now that is collectively, the Patterson's going to do it again. They're going to raise another 8+. Every one of them set records last year. I share this with you because this incentive for an individual to get a tax credit is for the year that they give. But it's going to an endowment that in itself is going to perpetuate itself through the life of forever if we handle our money correctly. So that 4% a year every year is going to have the purchasing power that for our nonprofits, for our communities, for impacts that we all want to have, that we might not have other than every year we have to ask the dollars for this. So as an example of Phil doing this, as an example for the Patterson Family Foundation, the community foundations are in Kansas ready to mobilize for the benefits and keeping rural communities healthy. I'm a big believer, having come from a small rural community, that we ought to have a shingle in every community in Kansas because, as Christy mentioned, the transfer of wealth is large. Oftentimes it's leaving our rural areas and not sticking around. Incentive programs like this can give all Kansas an opportunity to help their communities stay healthy and thriving in the future. And so I ask you to give serious consideration to this, and I stand with you today if you have any questions.
Thank you for your testimony. Committee, any questions? Seeing none, thank you again for your testimony. Is there anyone else wishing to appear before the committee as a proponent?
Thank you, Chairman and Committee. My name is Jessica Martin, and I'm the Executive Director of the Greater Salina Community Foundation out of Salina, Kansas. And we not only represent Saline County, but we represent 13 other rural counties in north central and western Kansas. And I just wanted to add with some real numbers that we're seeing of the importance of endowment. Last year in our fiscal year, through the Greater Salina Community Foundation and our rural affiliates, we granted back $21.9 million. If you endow those dollars over the next 5 years at a rate of return of annualized 8%, that can grow to $32 million. So in my mind, when I'm seeing the cuts that are taking place now and the change of hands of government, what no better way can we address some of those cuts than to endow dollars with local community foundations? The local boards know what those local needs are. You're giving money back to the local communities to decide how they can best help. Education looks different in Saline County than it does in Plainville, Kansas. Let those local boards decide what to do with that money, and we can work and do good things. But I just think the power of endowment sometimes gets lost. But those are real numbers that we're seeing every year, and something like Endow Kansas will only incentivize people more to give money to keep it here forever. Thank you. If you have any questions.
Thank you. Committee, are there any questions? Seeing none. Oh, Representative Sanders.
Thank you, Mr. Chairman. Jessica, give us just a real short history of the Salina Foundation. It's relatively new, and how quickly has it grown?
So we are 25 years old. We started off with a $2.9 million administrative endowment campaign. Over time, we are now $303 million in assets, and that's all from local dollars. In Saline County, we represent about 250 of those $1 million, and about 60 some odd is in our rural affiliates. Vern touched on the Dane G. Hansen Foundation and Patterson Family Foundations that are matching dollars. So this is just another incentive. If somebody's going to give to those unrestricted funds that those foundations are matching and to also get a tax credit, I think it would be a no-brainer for a lot of people. I work with a lot of donors who call and they want to make a donation to things that have those tax credits available. The unrestricted funding is harder to raise because everybody wants an opinion about where their money goes. But in reality, we don't know what the future needs are. And so by raising those unrestricted dollars and giving them an incentive, again, it helps our local communities become less dependent on the government funding. So I think it can be a really nice win-win and collaboration.
Thank you, Mr. Chairman.
Seeing no further questions, thank you for your testimony.
Thank you.
Is there anyone else wishing to appear as a proponent? Seeing none, would draw the committee's attention to a whole list of written testimony. A lot of support for this bill, and I do not show any opponent or neutral. Is there anyone wishing to appear as a opponent or neutral? I wouldn't recommend it. No, I'm kidding. Seeing none, we will go ahead and close the hearing on House Bill 2208. And committee, that does conclude our business for the day. Are there any announcements? Representative Helgerson.
It looks like Wednesday's going to be a free day, so we can have a subcommittee during the snow. Yeah, no one has any committee meetings, is that right? Isn't it going to be canceled?
I hadn't been made aware of that yet.
Well, if it is, we could have a subcommittee meeting.
Tax always meets all the time. Okay, stay tuned, huh? Okay. All right, thank you for your attention today. We are adjourned.